What's going on, guys? Mark Berta here. In this video, we're going to talk about covered calls. This is a strategy some investors are using to make $1,000 every single month with the stocks that are already sitting in their portfolio. This is the closest thing you can get to turning your stock portfolio into rental properties. So similar to how you can collect the dividend every single quarter, covered calls allow you to collect money on your investments every week or every month, depending on how you have it set up. And these could become quite sizable. So the way that covered calls work is you first buy 100 shares of a company. And with 100 shares, you are able to sell one call. This is a covered call because you want to have all these 100 shares in place first. And with this covered call, you give someone the right to buy all those 100 shares from you at an agreed upon price, and you get some kickback for enabling that person to buy your shares at an agreed upon price. So at this moment, there is a call for $490 Apple shares. They have the right to buy shares at that price. It expires August 28th, and someone has to pay you $1.37 per share to get the privilege of being able to buy your shares $490 each if they want. Now, what this means for you in terms of premium is that someone has to pay you $1.37 per share to get that opportunity, to get that option. But since every single call and put is 100 shares, you multiply that number by 100. So instead of making $1.37, you're making $137 straight off the bat from stocks that are just sitting in your portfolio. That's pretty much the setup for how covered calls work. With any investment, there are a different set of risks, but it's not too different from regular investing. The worst case scenario is that, let's say the stock goes down a little bit, and that's just if you bought and you held, it's the same exact scenario. Now, the difference is you did get to collect on your premium. So let's say today you bought 100 Apple shares, you set up this call that you sell to someone, and Apple goes down $20 in between this time. You're at a net loss, but that's the same if you bought in holds, but you do have the $137 call premium. And since the stock never hit the strike price, you get to keep all those shares. So you could do another call if you wanted to. You could sell another one to collect even more premium. Some people, they will sell calls at prices where they don't realistically believe the stock will hit. So let's say something like Apple to $580 in like 2 weeks. Like the chances of that happening are very slim, but people will sell that call. There are people who will buy that call, and it's not as much money if you move away from the current price, but it is increasing the likelihood that you do end up keeping those stocks. And again, $137, that's the premium. You can increase that premium by going further out. So if you go out to September 18th, the premiums look more juicy. And if you get closer to the price, so if you get, let's say, a call for Apple, $470 per share, that's going to look a lot better. And with expiration on September 18th, that's going to look a lot better than the previous scenario I gave you, where the price is a little further out and the expiration date is coming up very soon. So that's part of the risk with this strategy, because if you do end up selling the shares, you have to sell them at $490. Even if Apple rallies to $520, you do have to end up selling them at $490. While that is a risk with covered calls, you still make money. Not only do you make the premium, but you also make the capital gains. So if you buy Apple at $460, you set the strike price for your covered call at $490, and Apple goes up to $520, you miss out on the 490 to 520 part, but you do go from $460 to $490. So you do get the extra $30 per share in addition to your premium. So a covered call is a way for you to collect extra income, and you do cap your upside, but a lot of calls, they do expire and the transaction doesn't go through because for a lot of these calls, the majority of them, the strike price and the share price, you don't really see them meet. And you can, if you want to keep the shares, set a strike price where the stock like Apple or some other company, it's very unlikely to reach that price. And you can set it out for expiring within a week, where you won't get as much premium, but there's just a higher likelihood you keep the stock, versus 3 months or 4 months out where a lot more can happen, but you do get a much higher premium for your investment. The covered call strategy also presents extra dividend for the dividend investors. So a lot of stocks, they pay out their dividends quarterly, but you can get paid each month for holding a stock. Now, a lot of dividend investors, they do want to keep their stocks, so you can put a strike price up at a location where it's very unlikely to reach. And if you do set an expiration within a week of today, then it does get a lot more likely that you do end up keeping the shares. And some people, they have enough shares where they can follow this strategy every single week with a set of 100 shares for a single company, or you have 4 or 5 companies you're invested in and you have 100 shares or 200 shares of each one. And that makes it easier for you to run more covered calls. Like any investing vehicle, this is one that builds up over time and compounds very nicely. And since you are able to generate some extra income, that is extra income you can put back into the stocks. So for Apple, like I mentioned earlier, that's an extra $137 for something that expires in a week at a point where it's not entirely likely Apple hits that mark within a 1-week window. And you can put that into a little more than a quarter of another Apple stock, or you could put it into a few shares of AT&T or some other company. I do bring up AT&T here because when it comes to those types of stocks, it's a good dividend yield stock, but the price isn't really moving that much. And a lot of people know the price isn't moving that much. You can sell calls or puts for those stocks, and you're not going to get as much premium on those, but you can make a little bit extra in addition to the dividend. So some people, they will use those covered calls to just make some extra money while they do wait for the dividend payment. So covered calls, there certainly is a lot to it. I'd recommend testing out with a very affordable company. And I get that we have to look at market cap and we have to look at different numbers to figure out what's affordable, but we have to think, how do we accumulate 100 shares? If you want to get 100 shares of Amazon, that's going to take a really long time. 100 shares of Apple, especially during the after the split, isn't as bad. And getting 100 shares of something like a Bank of America is even easier. So we do have to look at a stock where you can realistically get 100 shares, and then that's when you can start to sell calls. I don't recommend buying calls and puts because that's where you are just hoping the price comes up. It's kind of like gambling. And when you see people post these incredible gains or losses in just a few days through buying calls and puts, it is a form of gambling because you're just hoping that in one day the stock price moves in a certain direction. While if you own a stock, you're just hoping that the fundamentals keep looking good. So there is a difference between buying calls and puts versus actually owning the stock. But what we're doing with covered calls is we are selling the calls. And this is where a lot of people in this space, it's the comparison where you could be the gambler where you buy and sell, you buy the calls and puts, or you could be the casino where you sell the calls. So that's the overall difference between buying versus selling options. And covered calls, they are a great strategy to build up extra income. It does take some initial capital to get to that point where you get 100 shares of a company, but the income can really add up. If in the event the stock price gets past the strike price and someone buys the shares, you can either wait for the price to go down a little bit, or you can just have backup options available where if this strike price is met and you have to sell the shares at that price, you have another company that you would like to invest 100 shares in and sell that call and start it all over again. So I do hope you guys enjoyed this video. If you did, please let me know in the comments any questions you have. Subscribe for more, and I'll see you in the next one.